Strong U.S. payroll data is usually seen as negative for gold, but the real story may be far more complex. In April, U.S. non-farm payrolls added 115,000 jobs, far above the expected 55,000. At first glance, this signaled a resilient economy and reduced demand for safe haven assets like gold. But beneath the strong headline numbers, several warning signs emerged. The labor force participation rate fell to 61.8%, suggesting that job growth is increasingly being supported by a shrinking labor pool rather than broad economic expansion. Wage growth also disappointed, with average hourly earnings rising only 0.2% month over month, pointing to weakening consumer income momentum. This leaves the Federal Reserve in a difficult position. Inflation remains elevated near 3.8%, while the unemployment rate sits around 4.3%. The Fed wants to avoid damaging the labor market. But persistent inflation limits its ability to cut rates aggressively. Markets now expect a high probability that interest rates will remain unchanged in the near term. This policy uncertainty is one reason gold continues attracting long-term capital. At the same time, global central banks are rapidly increasing their gold reserves. In 2025, net central bank gold purchases reportedly reached 863 tons, marking the 16th consecutive year of accumulation. China's central bank has continued adding gold reserves for 16 straight months. This trend suggests gold is evolving from a traditional commodity into a strategic monetary asset amid growing concerns over global debt, inflation, and our dependence on the US dollar. Meanwhile, inflation pressures and geopolitical tensions continue supporting gold's appeal. Sticky consumer prices and instability in the Middle East could keep energy costs elevated, complicating the global inflation outlook. As a result, many institutional investors believe gold is entering a new long-term cycle driven by monetary uncertainty, central bank demand, and structural global risks. The key takeaway is simple. Strong payroll data does not necessarily weaken gold. In today's environment, it may actually reinforce gold's strategic importance as both an inflation hedge and a long-term store of value.